View on the Market, a practical view of today's financial markets. Unlock the potential of your portfolio performance by maximizing your investments. Learn how mutual funds, exchange-traded funds, and real estate investments can create diversification. View on the Market starts now.
View on the Market. I'm your host, Jeff Sias, and we are joined today with Jim Dowd. Hold on, Jim. Let me pull you up here. My mouse is not working. There we go. Jim is a financial analyst, CFA for North Capital Inc. He's the founder. That's Jim. And we also have George Dosher.
Dosher, but either way.
Dosher. Shows you how professional I am.
Exactly.
George, yeah, exactly. We're all pros. And today we're going to be discussing how to generate income in a 2% environment, meaning how we can work our portfolio in such a way that we can beat, hopefully, the market average. And we're going to start that off with Jim. So, Jim, why don't you kind of take it away a little bit and explain to us what the heck I mean.
Okay. Well, sure. I mean, basically, what we have a lot of clients in a situation right now where they're either in retirement or close to retirement, and traditional bond yields and fixed income portfolios are, quite low because interest rates are low, given the general economic climate and the moves of the Federal Reserve. And equities may not be a great alternative for some of those people because of the risk involved and the time horizon that is required to generate returns. So really, a lot of people are beginning to kind of look broader for income opportunities that, essentially go beyond traditional bonds and sort of outside of equities. And really that's what I think we're going to talk about today.
So when you say equities, and can you explain like bonds versus annuities versus stocks versus ETFs, things like that? Is that what you mean?
Yeah. So equities are basically common stocks, and when you invest in a stock, you're basically buying a share of that company's underlying business, and that doesn't necessarily mean that you're going to receive any sort of a periodic income. It just means that you're buying a share of their profits over time. And then typically the way that ownership is monetized through time is either through appreciation of the stock or through dividend payments that are paid by the company. But the problem with that is that over the last few years, a number of companies have stopped paying dividends, or depending on the industry, never started paying dividends, and so you kind of lose out on on that ability to participate if you don't get the price appreciation in the equities. And so really, it's about trying to develop alternatives to that. Then ETFs and mutual funds are simply vehicles for investing in pools of equities or other underlying assets like bonds or other financial products.
So basically, if a company at one point, like say, I'm locked into Bank of America, I made a bad choice, I bought it at 20, they were paying the dividend, now they're paying like 1 cent, you're kind of like, you're like in between a rock and a hard place. You don't know when you should like bail on it, or you're trying to recoup your money. So you have to really think about the long-term effects of how this stuff changes, right?
Yeah, it's a question of timing on when the equity is likely to recover, when the portfolio of equities are likely to recover, and also whether or not you're in the sort of the right part of the capital structure of a company given your current needs. So in other words, if you're someone who's retired right now and really depending on a periodic income stream to cover your living expenses, then you might not be comfortable with investing in a portfolio of equities that you would have to essentially tap into your investment over time to kind of meet your spending requirements, to meet your expense needs. So the idea of putting together an income portfolio is is to kind of create a portfolio of assets that will throw off income naturally as by nature of the instruments that you're invested in.
And how do you do that?
Well, there's a number of there's a number of different types of instruments that you can use to effectively get that type of risk return profile. One that we use quite a lot is real estate investment trusts, or REITs.
Oh, okay.
These are securities that trade like equities. They're listed on the stock exchange. You can buy them through your discount broker, or if you have a financial advisor, you can purchase either through that advisor or through funds that invest in REITs. And they're basically, by statute, are required to pay out the profits that are generated by the trust. So these organizations essentially invest in rental real estate or commercial real estate, and they're run by professional investment managers, so they're trying to maximize the return on the investment. And then as the income comes in and the expenses are paid associated with the management of that trust, it's distributed in the form of dividends to the shareholders.
So say like in this financial kind of environment, I'll use the word, hey, that's the topic, financial environment. How do you, I mean, say like it's the commercial real estate, right? That REITs are more commercial, or it would be commercial, or housing, apartment dwellings, building, and things like that. Were
Right.
they affected as much in the housing kind of meltdown as regular residential?
Yeah, that's a good point. They were actually affected more, during kind of the initial phase of the kind of the financial crisis of 2007, 2008, because of the equity characteristics that they have. So, as the market declined through kind of general risk aversion and investors wanting to exit their risky investment strategies of which stocks were the primary kind of victim, if you will. Real estate investment trusts, REITs were affected as well, but they also came back very quickly because the second order effect from the financial crisis was a massive drop in interest rates, and so all of a sudden securities that are paying a consistent yield through their dividends became relatively more attractive.
So have REITs reached a level of being secure again, or are they subject to more pressures? If the say Greece, or because it is a bank, it's not really banks, because banks are financing it, right? So how does that work? You know what I mean? Does that make sense?
Yeah, no, they're basically subject to the volatility of the market to a degree. So they're not going to be as volatile as say a small cap stock or a volatile part of the equity market, but they will be exposed to the kind of general prevailing sentiment about market risk, and prices. The prices can go down as well as go up. So it's not just about the yield; it's also about kind of general investor sentiment about the market.
So do you kind of just try to balance everything out between like stocks, dividends, bonds, muni, utilities type thing? Is that to get it like a balance of say 4%? And it's like 4 to 5%. Is that realistic to kind of get off your money in a certain range?
So on the income strategies portion of investors' portfolios, REITs is sort of one example. And we can kind of go through some of the others, but the basic objective is to diversify risk across sectors that are not going to be correlated with each other, and hopefully will not be super highly correlated with the equities market, and which produce an income of between 4 and 6% depending on the sector. So just to kind of round out the picture, the other areas that we look at and can consider part of our income strategies portfolio, if you will, are high yield bonds, which are essentially bonds that are issued by below investment grade credits, where the primary source of return is the credit risk of the underlying company as opposed to the duration risk on the interest rates. Master limited partnerships, which are again publicly traded vehicles that invest in energy related infrastructure, so pipelines, storage facilities, rail cars, things like that. And then business development companies, which are investors, lenders to relatively small companies but on a fixed income basis where there's a coupon, if you will, or an income component as opposed to just capital appreciation. And then the last is preferred stocks, which are a little bit higher up in the capital structure than regular common stocks, and that's where you get the income associated with those securities. So those are kind of the main categories that we use for income strategies.
Is there one that covers the fuel market as well as the oil market, like a REIT for other industries besides real estate, something similar?
Other than MLPs, there really isn't. I mean, that's one of the artifacts of the way that the U.S. securities market was set up, is that if you have investment vehicles that invest in particular types of instruments, either you have to be set up as a mutual fund or an ETF, which is essentially a derivative type of mutual fund, or you have to have find a particular section of the regulatory environment to kind of register your type of vehicle. And REITs are unique in that they were specifically established and then have been protected over the years as a type of security that can distribute and is required to distribute most of its income. And that's why it's really kind of treated separately from other equity investments, because it does have this unique statutory requirement for distribution. And master limited partnerships have that similar type treatment.
So if you had to break it out, say you're a modest investor, say you're how would you do it? I mean, would you say I want to put 20% in REITs, 20% in bonds? Is there a magic formula, or is it just you sit down with an individual and say, okay, we talked about before risk aversion, and you kind of work it backwards.
Right. Yeah, it's really, I would say it's the latter rather than the former. I mean, there's really no magic formula. I mean, really the only formulaic aspect to it is that risk and return tend to be directly correlated. So if you have a higher appetite and tolerance for risk, then it would make more sense to have riskier assets in your portfolio, or a portfolio of risky assets, meaning less bonds, less cash. But there's no kind of magic formula in terms of what's the optimal amount of REITs, the optimal amount of MLPs, and so on. What we try to do is maintain diversification and make sure that our clients' portfolios are diversified, given the other investments that they have, given their risk profile and kind of stage in life. So it's really about, as you described, determining what the risk profile of the individual is, and then finding a way to blend those different asset classes in a way that ends up in an appropriate kind of risk profile given the income needs.
I think George has a question here.
Yeah. I was one of the questions I was going to ask actually earlier. What kind of like I do day trading, and I also, of course, like most other people, should have a 401k, and I actually take 17% of my salary and throw it in the 401k.
Mm-hmm.
But I set myself to trade myself $200 to $400 a month, set up, and I use Share Builder, and so I'll set up some auto trades, because I trade stables, like stuff to hold on to for a while, like Apple or IBM or whatever. But would you? I do have, like you mentioned, some bonds in there, and I have some financial stuff like Blizzard and stuff. That just keeps a good return in there. But say for somebody, we'll say like somebody's making like $50,000, maybe $60,000 a year. What would you think would be a good monthly, shall we say, how much should they invest a month or put aside a month, say to you as an example, so you can start investing for them? And say they're like 30 and they're just starting out now to invest. How much would you think they should put away each month?
Yeah, it's a tough question. I mean, it's really different for each person, because it depends on kind of what their disposable income is and sort of expense requirements are. So, for instance, in North Carolina, chances are your housing cost is going to be materially different than if you're living in the Bay Area. And so somebody making $60,000 or $100,000 a year there might have a higher disposable income than somebody making more than that here. And so it really depends on the particular kind of expense needs that each person has. And what we generally advise is kind of two things: save as much as you can and start as early as you can. And that's really kind of predicated more on the tax benefits of beginning to save early on and to defer and grow those savings than than the particular investments. I mean, that's just a kind of good prudent approach anyway.
Got you. And for most 401ks, because most companies offer 401ks, and a lot of them, you'd be kind of foolish not to go with a 401k anyways, because a lot of companies do matching.
Right.
So you're throwing away money if you actually don't put some money in there. But the 401k also offers very similar packages. You have specific bonds or stuff you can add to that, so they would purchase them for you. And of course, company stock that would be matched too, so you might as well go for that. Now, would you suggest a similar? I mean, and of course, the 401k is a little bit different. You're not going directly for stocks or anything like that, except for maybe company stocks. But I mean, would you suggest that they would invest in similar bonds and stuff that you would suggest going through your company as well?
Yeah, it really depends on kind of what the options are that are available through the 401k plan. I mean, I think you put your finger on it. I mean, if there are some companies that have a great plan, including some plans that have a brokerage option that really opens up a wide menu of investment options, and then there are other plans that are that are horrible plans, frankly, that have high expenses. They're kind of fee ridden. They're not diversified, and but having said that, it's still usually the sort of the first source of retirement savings because of that match. So when we talk to clients, we always sort of talk about the match first because, as you say, that's free money, and then the second thing is to look at the tax benefits that are available depending on whether or not you're in a traditional 401k or a Roth 401k, which is a relatively new development that is extremely attractive, especially for young savers. And then in terms of the specific investments, again, some of it depends on sort of what other sources of savings you have. Generally, income-type investments are good investments to have in a tax-deferred or tax-exempt account because it allows you to be optimal in terms of your tax exposure. Capital assets like stocks, if they're held in your taxable account, usually qualify for capital gains treatment, which for most taxpayers is a substantially lower rate than if you're investing in through your retirement account, the tax that you would pay on those income accounts, on those income strategies.
Yeah, but if it's on your retirement account, you're deferring those taxes to a later date, right?
Yeah, no, that's exactly it. So in other words, so take two examples. Let's say you have a bond that generates a return or some sort of an income instrument that generates a return of 6%, and that's taxed as ordinary income, and then you have a stock that you expect to appreciate at 6% per year. All else equal, you'd want to hold that stock in a taxable account because it's going to be deferred anyway because you don't pay the tax until you sell it, and once you sell it, you only pay tax at a low capital gains rate, and the income that you earn on your bond, which gets paid out every year, gets reinvested in that tax-deferred account, so you don't actually pay tax on it until you take the money out of the retirement account. So all else equal, income strategies typically are better sourced in a tax-deferred or tax-exempt account, and your capital assets usually go in the taxable account.
Yeah. All right. Well, my taxable account is getting smaller and smaller and smaller. So if you had to say tell a person you should be doing this, you're saying REITs are a good way of supplementing. Is that like what I'm hearing? And bonds and I mean, if you had to, I guess, prioritize it, how would you do it? I mean, what would be the top 4 things you should do?
Well, the first thing that I would say is make sure your portfolio is very well diversified. I mean, that's the most important thing. It doesn't matter, sort of the specific subclasses. If you don't have a well diversified portfolio that essentially includes both fixed income and equities as a starting point, then that's kind of the first place to start. And that also can be done relatively inexpensively through index funds or passively managed funds. So that's definitely the place to start, because the way that people really get hurt is where they have a substantial amount of their savings or their investment portfolio in a single stock or in a single handful of stocks, because if they happen to get that wrong and those investments don't pan out, then it's significant loss of the portfolio. So the first place is basically, the first recommendation is be well diversified. And then I think the second thing to look at is within that sort of universe of diversification, or under that umbrella, to begin then to look at some of these less traditional strategies, beyond equities, beyond stocks, and beyond bonds, to products like REITs and MLPs, master limited partnerships, high yield bonds, preferred stocks, and some of the instruments that are kind of the orphans of the capital markets to a degree, relative to traditional equities, because that's where you can get higher returns. And keep in mind, these are not low risk instruments. These are not no risk instruments. It's not like putting your money in the bank or or buying a government bond. But in a lot of cases, the risk is less than with traditional equities. And the benefit is that if we end up in a market where equities don't do anything for 4 or 5 years, as we have been, if you look at kind of the full market cycle, then you're earning income in the meantime.
So what's your thoughts on annuities?
Annuities are really more of a kind of a technique or a product to protect you against longevity risk. It's not really a risk, but the risk that you outlive your expected life. So really the investments that annuity providers are generally making are no different than the investments that you can make on your own, except that you can do it more cost effectively than the company that's writing that policy. So in most cases, annuities don't make sense for people if they are willing to spend a little bit of time to understand what's underlying those products, and what the actual costs and risks and potential benefits are. Where annuities do start to make sense is for somebody that is a little bit older and is concerned that hey, I've got good genes, I might live longer than my 85-year-old life expectancy, and I don't want to run out of money.
So you're saying people with gray hair perhaps are looking into annuities, and they should be looking into that reverse mortgage. So something a little bit easier. So I have to ask this really strange question. What is the minimum amount that, say, a person like yourself would, portfolio would work with?
Yeah, it really depends. I mean, we don't have any kind of a stated minimum. I mean, below sort of $10,000, it costs us more than we can make on the account in terms of a management fee. We charge a management fee of about 0.5% on portfolios of less than $1 million. And a typical advisory firm would charge between that and say 1.5% for smaller accounts. Some kind of have tiered structures so that they get paid a little bit more for lesser account minimums, and we just don't take that approach. We just assume that if a client believes that they need an advisor, then over time their assets will grow and they'll save more, and then our job will and the portfolios that we manage will kind of grow as well. But a lot of times you'll see investment minimums of $100,000, $250,000. Some are $1 million. There's some managers who won't take accounts less than $5 million. But most of the time, I think if you do a little bit of shopping around, you'll find an advisor that has strong credentials, a fair manner of dealing, and will kind of look at smaller accounts.
So I got another. Unless George has a question. Can you manage people's 401k accounts as well? Is there any issue with that?
Yeah, it's a good question. We can't actually manage 401ks on a discretionary basis unless there's a brokerage option associated with it. So what we do typically is as a part of our financial planning process, we'll look at an individual's retirement plan options and then make recommendations with respect to that plan and the funds that are available for investment. So, let's say you have a 401k, you've got $200,000 in that, and you have a taxable account with maybe some money in that, and maybe you have an IRA or a rollover from an old job. We look at all of those all of those accounts together, and then put together an integrated management plan, investment management plan, for those accounts. And part of the implementation of that plan would be reallocating your 401k investments amongst the funds that are available through your account.
So would you reallocate it on a quarterly basis or a monthly basis? How is that done? And then, because you can't actuate it, they have to, right? I mean, you would send them a roadmap, and then they would deliver on it. But would it be quarterly or monthly?
Well, so for the 401k, it's generally quarterly. I mean, a lot of times 401k plans have limits on the number of times that you can, rebalance during the course of the year, both in terms of contribution investments as well as the existing portfolios. But generally 4 times a year is adequate. We certainly don't try to time the market on behalf of our clients or make tactical recommendations with respect to those investments. It would be a horrible vehicle to try to do that anyway. So it's really more about making sure that the overall mix is well balanced, diversified, representative of the asset classes that are available in the plan.
So are there companies that actually, I mean, I say I work for Bank of America, and which I don't. I don't work for them. But say, because I'm using them as an example everywhere I go now. But say I work for Bank of America. I have a 401k plan. Can I administer it? I mean, I do administer it, right? But I don't have the option of saying, like you say, I can only rebalance it. I can't take that money and say move it over to a Charles Schwab 401k account and have them fund it there. It has to be through themselves. Is that true, or am I making sense?
Generally, that's true. I mean, there are rare cases where companies allow something called an in-service distribution, and what that means is that you're allowed to roll over a portion or all of your account to another provider in the form of a tax-free rollover. And it then goes into an IRA, at another firm that you can self-administer. But that's really the exception more than the rule. I've only really run across 2 or 3, firms in my career where people have had the ability to do that. What's more common is that you have discretion, within the funds that are available in the plan. What's increasingly popular is to have a so-called brokerage option in the plan, which allows you to open up a brokerage account under the auspices of the plan, and then to self-direct those investments through the brokerage account. I mean, that can be a double-edged sword, right? Because you might do a really good job with that, or you might, do a very poor job and, do worse than what you, would do if it were left to a professional investment manager. But that option is available, and, since we're in America and choice is usually viewed as a good thing, most people like that type of option. And then if you were, ever to leave that plan, then of course at that point you have the option to do a tax-free rollover. That's called a rollover 401k, and that's really the source of a lot of rollover IRAs that exist, is old 401ks that got rolled over when people changed jobs.
And then it would be different if you had like a SEP, right? If you were self-employed, you would actually control your own account, and then you could turn that over to another individual to actually run that.
Yeah, that's right. I mean, for self-employed individuals or for entrepreneurs, there are a number of options like the SEP IRA or the Simple IRA, or now actually you can do what's called a solo 401k, which a number of self-employed individuals are doing, and it's really no different than a regular 401k, except that it's self-administered through a brokerage account, and you decide kind of how you want to manage that money. And it's coded separately at the custodian, but for all intents and purposes, it works just like a 401k, just like an IRA, but it has separate contribution limits, separate kind of tax treatment from your overall investment standpoint.
So, George, do you have any questions, or are you good?
Yeah, actually I do. Like say somebody had I don't know, an extra $10,000 or $20,000, and they wanted to actually invest in, say, like your company or what. I mean, in whatever you do there. I mean, I've never done what you do, so. But like, how would one get involved? And say, like, I have an extra 10 grand. What do I do with it?
Right.
Give it to me. Give the 10 grand
Besides
to
giving
me.
it to Jeff so he can spend it on, I don't know, whatever he would spend 10 grand on, camping equipment or an RV or something.
Yeah, I mean, so I think what you're really asking is how do financial advisors, kind of manage client accounts? What is that, what's the process by which those accounts get open to that? So yeah, that varies from advisor to advisor, but what we basically are a non-custodial advisor, which means that we don't actually keep control of the money directly in our firm. We actually use a third-party custodian, and in fact, we use Schwab as our third-party custodian. So any contributions that you make or any money that you contribute shows up in an account that is maintained at Schwab, and then we have limited trading authority and reporting authority over that account. So from your standpoint, you have the benefit of all of the systems, all the infrastructure, all the safety and security of being in a large institution, but at the same time you can work with a personal advisor who will kind of manage that account on your behalf. And so, that's a very common model in the in the fee-only investment advisory world, and Schwab is the largest custodian for independent advisors.
Got you. Another question now. Say like they wanted to invest, I don't know, whatever, an extra $200 or $300 a month, whatever they had. Would that be, they could access their account and just basically say, hey, I'm going to put $200 a month in here and keep adding it to it?
Yeah, so that's like a direct contribution plan, and that's quite common. I mean, we also have it go the other way where somebody's in retirement and they have a big pool of assets that we manage on their behalf, and then each month they ask for essentially a distribution that they're going to use to basically be their income in retirement. So yeah, it works both ways, and typically what we do in those cases is we link the account to their bank account, and so the bank account they keep a small reserve there, use that for their expenses, and then whenever they need money out of the kind of the clearing account, the custodial account, they either call us or they can call Schwab directly, or they can go online and make that transfer directly.
So I got a question because it's my show. just teasing. No. So what's the safeguards from having a financial, say in this custodial environment, from them not transferring all your money out? I mean,
yep.
How does that work? Where's the gatekeeper that says, okay, trades are effective, but money transfers are off base? How's that work?
That's a great question, and that's really the reason why most independent advisors have a third-party custodian, is to provide a safeguard, precisely, against that type of malfeasance. So what we basically do is within the terms of the agreement that we have with the custodian, there's limited power of attorney that we have to affect trades on behalf of the account, but not to be able to, affect any sort of wire transfers or transfers out of the account other than as pre-arranged by you. So, there's one bank account that's associated with the account, and you can move money freely in and out of that bank account, but that's your bank account. It's been validated by the custodian firm, and we don't have any ability to send funds anyplace other than to that account.
So, George, you're up. You got a question?
Not really. I mean, I've been thinking about doing some investing myself. I actually do my own. I do some day trading and stuff, and I do very similar to what he does. Never really had an investor, just besides having a 401k and then taking some courses in investing and just actually setting up a day trade thing, because I do work from home.
Okay. So I got one last question, and then we'll kind of wrap this up. So when you say create the model for the types of funds that you're going to be in, of say the roadmap to success, how do you and you revisit it on a quarterly basis or on a monthly basis, whatever you're doing? Is there a metric for how, say, you're doing versus the market or something like that? You know, is there a metric for success? Or saying, yeah, we're doing a great job right now. We're at 6%. That's our goal. The market was at, you know, was pulling back on the Russell 500 or whatever was only at this, and you know, something like that. You know what I'm saying? Is there some kind of metric that you guys follow, or you send a report every month, or what takes place so the end user knows it's working? You know what I mean?
Right. Right. Well, yeah, and I guess so embedded in your question is really two questions. One is you know, how am I doing against my plan, or even more importantly, you know, how am I doing against my needs and goals? You know, in other words, you know, if you know, if I think I need to make 6%, you know, a year, and you know, I'm making 4%, then I may be outperforming, you know, my benchmark, but I may be underperforming my need. And you know, there's a saying in finance: you can't eat relative returns. So even if I'm the best relative, you know, investment manager, that may not do very much good for you if you're depending on that income to be able to fund your retirement, or you know, to fund your expenses. So I think the first thing is, you know, evaluating how the portfolio is doing relative to the objective need, you know, that is embedded within your, you know, personal needs and personal goals. And that's something where hopefully if we've gotten the risk profile right, and the asset allocation follows the risk profile, then you know, we should be able to sort of check in monthly or quarterly and know that, you know, yes, we're kind of doing what we expected, or you know, it's within reason, or you know, we need to make some changes. And that's something that, you know, that we monitor and sort of check in with our clients regularly on. And then the second issue, which is more of the issue of, you know, okay, given this allocation, you know, how good of a job have I done as an investment manager in terms of selecting the funds that we're using to meet that particular asset allocation? That's something that in the industry is referred to as benchmarking. You know, meaning that you set a benchmark, which is a particular asset allocation or a particular, you know, kind of mix of funds, you know, mix of indices, mix of asset classes, and then depending on how the actual portfolio does relative to that benchmark, you can tell whether or not your advisor has done a good job or a poor job relative to that benchmark. So typically, you know, a good advisor should do, you know, about in line with the benchmark, or kind of the benchmark less fees, because again, the asset allocation in general is designed to meet a particular benchmark, so you would expect it's sort of a best case to be, you know, right on top of, or maybe slightly, you know, above a benchmark, but you know, but never substantially above. I mean, if you deviate substantially from that benchmark, then that means that, you know, the advisor isn't sort of doing their job in terms of, you know, giving you a portfolio that's in line with the benchmark.
So the benchmark, I'm just going to tie this all together. Yeah. The benchmark is really based on the asset allocations that are really set up to begin with. So kind of if you get the model right, you build it right, they will come type thing. So yeah. So you know, that's how it's going to work. You have to really understand what the asset allocation is, and then kind of it takes care of itself. You probably have some triggers in place if something is going awry, so you can make a midterm adjustment, or you know, whatever you do, right? So that's kind of how science is in the beginning.
Yeah, that's exactly right. I mean, there have been a lot of academic studies that have shown that up to 90% of investment returns are determined by the underlying asset classes that are selected in a portfolio. And so that's really the number one most important decision that you can make as an investor, or that a financial advisor can make, you know, with regard to your portfolio, is what asset classes are, you know, are used in putting together your portfolio allocation. And then after that, then sort of choosing the specific funds and the specific investments, you know, really is kind of a second order issue, design, you know, which is to kind of match that asset allocation that you set forth to begin with.
Right. All right. So I'm going to, first of all, I want to thank everyone involved here. So let me go back over here. Thank you so much, Jim, and thank you, George, because without George, there would not be any intelligent questions here. So
actually, I thought I was having rather stupid questions.
No, you were right on target there. So I want to thank you both so much for the show, and we're going to do another one in 2 weeks. Hopefully, you both will be there. let me just tie this out. I'm going to close out the broadcast, and then you guys stay online, and I'll just come back to you, okay? Is that all right?
Okay.
Great. Thanks a lot.
Thank you so much. See you guys in I'm going to play the end of this intro because I'm just enamored.